Today we are discussing WW Grainger Inc., ticker GWW. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. First up, this is a market cap of $33.5 billion, enterprise value of $35.4 billion. So you see about $2 billion in net debt on this business. That's less than 10% of the enterprise value, so not a lot of leverage there. Now, the industry is a trading company and distributor, and so they distribute maintenance, repair, and operating products and services in U.S., Canada, Japan, UK, and internationally. Two segments. They have high-touch solutions and endless assortment. They have safety and security supplies, material handling, storage and equipment, pumps and plumbing equipment. They also serve business, corporations, government entities, etc. So, this is a really interesting business. These sorts of distributor businesses have a lot of products, and the whole key is that they're able to provide stuff on short notice and have the selection needed to provide to various companies all across the country and all across different businesses. So you can see this safety, security, material handling, storage equipment, pumps, plumbing, all of these types of things, these maintenance type solutions are relatively low cost on an individual basis, but they might be able to have relatively good margins because of concentration and, of course, the ability to provide convenience to their customers. Now, return on invested capital, this immediately looks really, really interesting. Not only do we see 20 straight years of profitability, but we see 20 straight years of return on invested capital above 10%. Almost always when I see this company is going to immediately jump to the top of my watch list of interesting stocks because you're seeing this really strong returns on invested capital. Every single year they have above 10%. It looks like the lowest year was actually in 2003 at 11.9%. They haven't been below 13% since 2004. I mean, really, they're in the 14% plus range all the way for the last decade. Very attractive returns on invested capital, very high quality business. Likewise, you can see some pretty good improvement over the last decade as well. Return on invested capital 10-year average is 18%, outstanding. Return on equity 32%, outstanding. Return on assets 14%, outstanding. And you see a little bit of increase here that is probably because of the leverage that they do have, but still really attractive results here on the 10-year median returns. Now, when we're evaluating valuation, so everything we've seen before is saying, hey, this is a really good business. But when you think about valuation, what comes into play is both your current price as well as your growth perspective. Now, price to book of 12 would normally be concerning, but when you see that the price to sales is 2.2, price to earnings is 21.7, the price to book is being distorted. It's probably because there's been buybacks bought at higher than book value that can really distort the book value of the business. So I'm going to ignore price to book. Now, on a price to earnings basis, we see here you had a PE of 21.7. That's about a 4.5% earnings yield. And then if you think about that, you can then add the revenue yield of 5.5% and think that you're now having 4.5 plus 5.5 that gets you a 10% potential return. Starts to be very attractive when you can say, hey, I can pretty easily see how you might hit double-digit returns because you have a starting earnings yield plus your growth. That's a very basic equation for estimating potential returns. That number gets you to 10%. Likewise, we can see with the return on invested capital numbers here of 18%, return on equity of 32%, that they're able to self-fund all of that growth. They're not going to require additional debt in order to grow, so that means that they can grow with completely internally generated cash flows. That's a good sign as well. And you also see free cash flow growing at 6.5%. So added to this, maybe you say you have potential for 11% returns and EPS growing at 12%. That's another sign that they're probably using buybacks because of the gap here between revenue growth and EPS. That can really come from a few areas like operating leverage and or stuff like buybacks. Both of them would be very attractive markers to see in a business like this. So I'm excited to dive further into the financials to really back that up. All this is saying here is this company doesn't look overvalued. Now, it's certainly not cheap. Cheap companies are PEs of 15 or less, below average prices. We don't have a below average price here, but we're saying maybe this is a fairly valued company because a fairly valued company would be a company that can pretty easily see your way into a 10% return, and a very simple 4.5% plus 5.5% gets you to that 10% return, and with the potential for higher when you really think about what the EPS growth rates are. So valuation seems reasonable. Very high quality business though. When you can get a very high quality business at a reasonable price, that starts to get exciting. Now, Revenue growth rate of 5.5% does not lead to doubling in a decade, and so you see they started at $9.4 billion in revenue, end at $15 billion in revenue. That is not even a doubling. Now, it's a little bit slow for what I would like to see, but we can see if maybe their operating profit does better, and you do see that. You see this $1.297 billion in operating profit to go to $2.2 billion, so they've almost doubled in the course of the decade, so that means your operating profit, of course, growing close to this like 6.5%. That makes sense as well. But even more attractive would be your EPS number, which has gone from $11 to $30 in a single decade. So you're basically tripling in a decade, and that becomes very attractive. Now, a true triple would be the 12 to 13% range here on EPS, so you need a little bit higher, but otherwise you're in a very attractive number. I really like the idea of 12% growth. 12% is enough that, with a little bit of changes, you have some margin of safety for hitting a very good market-beating return. When you think the market, over the long history, returning 9-10%, you can hit 12% growth. You're starting to get into a very attractive number. But the key is they are not growing at 12% without paying a dividend. They're still paying a dividend with this growth. And how do you do that? Well, you do that when you have very attractive returns on invested capital. Everything here is falling into place for being a watchlist company. Everything looks really good here, and it's because of how these numbers come into play. And one of the things you can see here is just some of the operating leverage that's going on. You had this revenue growing at, like 70% over the course of a decade. Your gross profit grew a little bit slow, 30% here, but your operating profit grew close to 80-90%. So that change in the operating profit actually growing faster than revenue is a really good sign. Your operating margin has increased from 13.7% to 14.5% now. Your gross profit margin is actually down over that time frame, which makes it a little bit more impressive that they've been able to pull that off. Now, dividends. Let's add this dividend into kind of our valuation framework. So you see the dividend here of $6.78. We see the close is $677. So you can see that their dividend is about a 1% dividend yield. So let's just add that 1% dividend onto our growth rate here, and you can say, okay, now that gives us a different framework for our valuation, because one of the ways you can do it is you can do an earnings growth based method, and that's what I did here, 4.5%, 5.5%. Another way is you have a dividend growth method, and so you could say, okay, well, I have a 1% dividend plus 5.5% revenue growth, which means a sustainable bottom line might be a 6.5% return on the low end of what I might expect. If you use free cash flow, you could say maybe your low end is 7.5%. If you use EPS, maybe you could say that you can grow as fast as 13% a year, which is a very attractive return. So what do we have? Well, we have a bounded return expectation of 6.5 to 13.5% return. None of those returns require debt because our return on invested capital and our return on equity substantially exceed those numbers. Even our return on assets exceed those numbers. So very attractive there from the numbers we see. And of course, just going to show how well that works out. You can see that they grew faster on the dividend at the beginning of the decade than the end. So perhaps current dividends are growing a little slower. You don't have that concern on the EPS though, because some of the fastest growing years are the last 2 years. With that said, this is something to be aware of because maybe COVID has juiced their returns. Maybe their current sustainable earnings is a little bit lower. But you are, one caveat on the valuation. It's using this high number, $30 a share. You take this to the $667 stock price, you're saying $21, $22 or 22 PE on max earnings. If their earnings regress to a PE of earnings of 20, now we're trading the PE of 30 plus. The company gets a lot less attractive. So you need to be confident in this company actually earning $30 a share. How do you do that? Well, you need to do further analysis on the income statement, balance sheet, and cash flow statement, which we're going to do right next. But what I need you to do is hit that like button. Don't forget to subscribe. I'm putting out videos all the time. So let's go into the income statement and take a deeper look. Now, again, we can see that their cost of goods sold has been going up pretty substantially. So you can see some of that inflation on their producer side really coming into play. But where did the operating leverage come from? And what you can see here is the SG&A here had $2.8 billion and you grew to $3.6 billion. So you had an additional $800 million in sales, general and administrative costs. But how much did you add in gross profit? Well, you added $1.7 billion in gross profit. So your incremental margin on there was closer to 50%. You're able to convert 50% of that gross profit growth into operating profit growth. because you grew your SG&A slower than you grew your gross profit. That is the definition of operating leverage, which is probably one of my keys for outperforming as an investor, is if you can find companies with good operating leverage, it can really set you up for outstanding returns in the future. Now, can they repeat that? I don't know, but it does say in the past they've been able to pull that off, and that's a really good sign. It's how you can go in 3 years here from 2020 earning $1 billion in operating profit to $2.2 billion in just 3 years, and it's because of that operating leverage really coming in and taking an effect. Now, one of the benefits on the net income side, always worth remembering, is the Tax Cut and Jobs Act of 2017 did lower your tax rate. So you can see this pretty clearly here that you had $936 in pre-tax income here, and in 2018, $1 billion in pre-tax income, yet your income tax expenses went down. That is because the tax rate, corporate tax rate, dropped. So something to be aware of, that EPS growth rate is probably not as repeatable, just because you're not going to necessarily repeat a reduction in the corporate tax rate. Always a concern when looking at companies that have a 10-year history of this sort of growth is that some of that EPS operating leverage is not repeatable. Some of it is, some of it isn't. Or some of it could be, but some of it certainly isn't. Now, why did EPS grow even faster than net income? You can see the net income basically doubled over the course of a decade, but you were almost tripling your EPS. How did that happen? Well, you retired 30% of your shares outstanding. You went from 21 million shares outstanding to 51 million shares outstanding, taking a whole 20 million shares off the market. That's a very impressive way to add an additional 2 to 3% per year to your EPS growth rate, and we see that here. So I want to go back to this overview. You see this 12% EPS growth. Without buybacks, this would be a single-digit number, but with buybacks, they have a double-digit number of 12%. So that's very impressive because they were able to take what should have been maybe a 9% return, or 9.5% return, and turn it into a 12% return, which is really the key to where you start seeing this outperformance potential. So good work on the capital allocation from management's point of view. Now, let's go to the balance sheet. Or one last thing on that. You can see that this has slowed down a little bit in recent years. So just something to be aware of, that they may not be doing it as much. Balance sheet. One of the keys when you look at any sort of these ton of distribution companies is where is the capital going, and you can learn a little bit about that when you look at this business. You see $1.1 billion in PP&E at the beginning of the decade, $1.8 billion in PP&E. So you're up about 60%. Now, how much is their net income going up? More than 60%. Always a good sign there and something to check. Likewise, you can see they spend a lot of their capital on accounts receivable and inventories, so there is a decent amount of working capital in this business. As I said, I do know a little bit about this Grainger business already. I've looked at it in the past. Part of that is they have to maintain a large amount of inventory. You can see they have more inventory than they have PP&E, and that is to provide the selection that the customers need because they're selling convenience. That's what allows them to sell and make the margins that they do. So they need some of that convenience in there, and that leads to working capital. Let's see, long-term debt, $2.2 billion. You've really expanded your long-term debt from $467 to $2.284 billion. So you can see they're up 4 to 5x on their long-term debt. It's a pretty significant increase in long-term debt. They didn't grow their net income at the same rate. Now, their long-term debt is not out of line with the PP&E. It's not out of line with their inventory. They're basically matching it off against those numbers, and they've been a little bit more aggressive at the end than they began. But it does lead to some of these changes that you see in your book value, where your shareholders' equity has decreased over time because what they've done is they've bought back shares. You had $3 billion in treasury stock. Now you have $9 billion in treasury stock, but then your shareholders' equity is actually lower today than it was, and yet you have bigger balance sheet. All that's doing is it's impacting this number that I saw at the very beginning, the price to book ratio. So we know that those buybacks being bought at higher than book value are going to lead to an increase in this line item on the treasury stock. And so you're going to see this line item of treasury stock go up. And I'm saying go up. It is a negative number, but the negative number is going to increase because of those buybacks equivalent to that amount. And so that's just saying that that's going to reduce then the shareholders' equity line on this. And so you have retained earnings going up, but your treasury stock's going down, and it's just impacting those numbers in opposite ways. Let's go to the cash flow statement. One of the things you always want to check when you have these PP&E spending every year, kind of take a look at depreciation and amortization. They're not out of line. They're not substantially lower or higher. So it just means that this, pretty reasonable numbers on the cash flow. If there was a significant gap there, that'd be something I'd worry about. Now you do have pretty consistent. It looks like, negative changes in working capital. That's because in order to grow, they need more inventory. And so they're having to spend that money there. That's a real expense for this business because they are holding that inventory on an ongoing basis. They couldn't grow without having that working capital. Just something to be aware of. It's not something you could see really wholesale reduce. It looks like every year except for 2 years in 2016 and 2017, you saw them having to invest in additional working capital. That's what you see there as well. They're not making a lot of acquisitions, which is always something I like to see in a business. I don't like a lot of acquisitions. It's really hard to predict future acquisitions, and so something you would see on that point. Now, net issuance of common stock, this is your buybacks. You can see they're making buybacks each and every year, which is always something I really like to see, and then I need to compare that to stock-based compensation. And what you can instantly see is there's an order of magnitude gap here, which is absolutely amazing. You could see $56 million in stock-based compensation, 438, 49, 525. When your stock-based comp is in tens of millions and your buybacks are in hundreds of millions, that's a really good sign that you're actually going to retire shares. One of the biggest problems with these companies that have steady buybacks is they're not actually retiring shares. They're issuing new shares to management, and then they are buying back stock that doesn't actually get bought back and retired, but that is not the case here, and it's why they've been able to retire so many shares outstanding over the last decade. So great capital allocation on that sense. It looks like most of the debt issuance occurred in a 2-year period of 2015-2016 when they did a lot of buybacks. So really this is not really so much a change in how the business is being run. It was just an aggressive allocation of capital. Now, maybe there was a really good price for those buybacks, so that could have been really profitable for investors. You can also see that they've been doing these dividends pretty reliably, but they've not been growing super fast in terms of the actual cash flow. So I like everything I'm seeing here. This is very good capital allocation. I love seeing buybacks. I love seeing dividends that are growing over time. It's a very good sign for me. You see some signs of operating leverage on the income statement. That's a really good sign. You both see it here from gross profit down to operating profit and net income, but you also see it with those buybacks taking place. All this creates a situation where you've been able to turn a company with mid-single digit growth, 5% growth, 6% growth, and turn it into double-digit EPS growth, all while paying a dividend because the returns on capital are amazing, 18%, 32%. These are outstanding numbers. The high-quality business, you've been profitable each and every year, and that growth has turned into a really good return for shareholders. So I'm really excited about what I see here. So WW Grainger is going on my watch list. This is the prototypical high quality business trading at a fair price. And so that is my thoughts on Grainger. If you enjoyed this video, hit that like button and don't forget to become a subscriber. My subscribers are the ones learning the most. And so you should definitely be a subscriber to learn from me as I put out more videos on every company in the S&P 500. If you want to use this software that I use, quickfs.net is the affiliate link in my description below. First link there, check that out. And you can get this software as well. It's free to use or paid depending upon what features you want. So please hit that link. It's a great way to support the channel. Thank you for listening. And until next time, stop paying fees, start building wealth.